So the markets are down over 30%. Now, what stocks am I going to be investing into, and what is my plan? What's going on, team? It's Ricky with TechBud Solutions. I asked you if you guys wanted me to break down. I'm investing an additional $50,000 into companies that I personally see value in. This is actually something that we talked about at our TechBuds HQ just yesterday for our risk management in-person session. Friendly reminder, if you're part of Learn, Plan, Profit, you get access to our TechBuds HQ, which is a 7,000 square foot facility that I bought in Chandler, Arizona. So I hope that you guys know that if you're ever in Chandler, just make sure that you Google search TechBuds HQ, and you're more than welcome to use our space. We're open Monday through Friday, and it's at no additional charge for all of our Learn, Plan, Profit members. But let me go ahead and get right to it. I actually created this little risk management calculator. If you're part of our group, I'll share it in the announcement section. I have it under numbers, but I know a lot of people don't use MacBooks, so I'll either create it as like a CSV file or an Excel or something like that, so anyone can use it. This should be in the announcement section. If you're not part of any of our Discord groups, the first link in the description will be for my free Discord. We have over 40,000 members. You can feel free to join, and in the announcement section, you should be able to download this. So one of the first things that I want to talk about is, what companies it is that I'm choosing to invest in. And does this mean that like my $50,000 is all I'm investing into? No, right? I'm a big believer in position size, meaning that I will not be fully invested in any of my positions until we have actual indication of a recovery. I'm sure that all of you guys can agree that it's one of the worst feelings when you're fully invested and the market keeps on dipping and you have no more money to buy. Past 5 months, if it's taught us anything, it's that the market can continue to dip if things are getting worse. So instead of hoping that the market recovers, I'm just deciding to take small positions in these companies that I value, that I don't expect to recover or don't need to recover anytime soon, and I'm in it for the long haul. My intention is to hold them for a number of months and or years, if that's what it takes. The simple thing that I want you to understand is when you're making this for yourself and you're choosing your 1 to 3 different stocks, ask yourself, make sure that you can tolerate the time that it will take for the market to recover at worst case scenario. You need to understand that. I'm not making this video trying to feed you the idea that the market's going to recover right away. No, it's not an if the market's going to recover, it's when, right? At least based off previous patterns. But will you be able to tolerate the time that it takes for the market to recover? That's what I want you to think about. Be enough invested that you take it seriously, but not so much that you become an emotional mess. And only you can determine that. So the way that this thing breaks down is Tesla, Amazon, and Apple. They're 3 of the companies that I personally value, and they're 3 of the companies that I personally want to take advantage of. Just because I see value in them does not mean that you need to. I'm not going to be like other YouTubers. I don't care what it is that you choose. I encourage you to choose your own 1 to 3 versions of your most valuable companies. The thing that I like about Amazon and Apple is I find them to be monopolies in the industry that they're choosing or that they partake in, right? Amazon, an e-commerce giant, and then Apple, when it comes down to cell phones, tablets, it's Apple everything, right? Tesla, I still view it to be one of the only market leaders in EV, right? I feel like all the other companies are still 5 to 10 years behind. They are where Tesla was 5 to 10 years ago. They have so much to catch up to with overall manufacturing and production wise. Tesla and its Model Y is set to be the most produced vehicle for 2022. And this is exciting, right? Over 400,000 units are set to be made, outperforming any other manufacturer for vehicles. That's a big improvement from where Tesla was in 2009 and 2010, right? With that being said, I want to break it down for you guys. I want to explain to you guys my entries. I want to explain to you guys my exits. I want to explain what the cutting losses means and what the RRR means. This is the risk to reward ratio. And this is all automatic. I'm also going to just do an example for TQQQ. I'm going to break it down to let's say that my average entry for TQQQ, I decide for it to be $50, right? My exit, I expect it to be, based off of previous highs. If we look at TQQQ, it's $91 a share. Being a little bit more conservative, knowing that I'm not a perfect trader, right? right? So why set unrealistic expectations? I'm going to set my exit at 80 instead of 90, right? And then when it comes down to cutting losses, have to keep risk management into consideration. So if we wait for the break above 50, meaning that, again, this is for like long-term position, this is just an example, we can see that the EMA line right now on the day chart is below $44. Waiting for the break above 50 gives us some cushion. So average purchase price at 50, I like to average up into my position. I never go all in just one position. I like to make sure that direction's in my favor. The more that it goes up, the more I add to it. But let's say that I have to cut losses. If my average purchase price is at 50, let's say that I cut losses at 45. With that being said, I can just drag this little thing down and it should calculate my risk to reward ratio. So I have the potential to make 6% for every 1% that I'm willing to lose, right? Or 1% that I'm willing to risk. That's how this risk to reward ratio works. It takes into consideration your upside and it takes into consideration your downside. Obviously, you always want to make sure that your upside outweighs your downside, as no one is a perfect trader. So depending on your success rate will determine how aggressive or how conservative you can be with your risk to reward ratio. I find this tool to be somewhat useful. If you think that you're a beginner and you would like to begin to plan out your trades, again, this is going to be pinned in the announcement section of our Discord group, which is the first link down below. But let's go ahead and break down Tesla. Now, again, just because I'm talking about Tesla, just because I'm choosing to invest in it, does not mean that I encourage you to do anything of what I'm doing, right? If I'm okay with tolerating and taking a risk, it does not mean that you should be okay with it as well. Based off of experience and confidence, we all tolerate things in a different manner, some more aggressive than others. So please understand that if you want to be more conservative and you want to wait for more proper confirmation, then rightfully so. Wait for that confirmation. You don't have to take an aggressive approach. But as of right now, we're trading at $728 a share. As you guys can see, I already have some shares in Tesla, and I intend to average up into Tesla. The idea with averaging up, it increases my average purchase price. Right now, the EMA is set at around 900. By the time that the market actually begins to pick back up, I see it to be right around the 850 to 880 general area, just like we did last time. And with that being said, I set my average purchase price at around $850 a share. I mean, looking at where we're at right now, I mean, it hit lows of $600 or $690 or $680, something like that. Right now we're at $728. I have a lot of margin to work with. You can see that with my average purchase price being at $850. We are setting proper and realistic expectations. I don't expect to buy at the lowest price point. I don't always view that to be the most essential or necessary thing. The thing that I find to be more important, in my opinion, is market direction and market sentiment. Is the market actually indicating signs of a recovery? And also, is the market actually not getting worse from what it was previously showcasing, right? Inflation, interest rates, Russia attacking Ukraine, oil, all of those things, right? COVID, are things getting worse? And if not, and if things are getting better, then therefore I have more confidence to average up into my position. With right now being at 730, I can easily average up with not perfect entries, anywhere from, my average of what I set to be 850. My exit, again, this is just a goal, something to work towards, is around $1,200. The previous highs is $1,243. I can hold a little bit longer. I can begin to reduce position size as we approach over $1,000 a share. There's many different ways in doing so, right? So knowing that my average purchase price is, again, a goal of set to be at 850, and knowing that the exit is set to be right around 1,200, that's a 40% ROI. One of the things that I talked about in yesterday's in-person session is how important it is to set realistic expectation. Even with that trade plan, I have the potential to make 40% ROI if my trade pans out perfectly. But let's be honest, it's not going to, right? It never does. And it's not realistic to set those expectations. So one of the main reasons that I tried to calculate what the ROI potential is on my trade plan is it showcases 40% ROI, but mentally, I then begin to prepare myself for half of that. I anticipate to make 20% ROI because I expect to be half as perfect as what that ends up actually playing out to be. And the reason I say that is I need to leave some margin for error, right? Either my entries and or my exit is not going to be perfect in how I average up and or average out. So with that, I don't want to set the false expectation of 40% ROI, although that is possible and I could potentially make more. I think it's more appropriate to set a more realistic expectation so I don't end up, I would say, striving for something that I end up chasing at the very end. whatever it is at the goal or the potential it shows me to be, I always try to cut it in half and just, again, leave some margin of error, right? With that being said, let's go ahead and move on to the next one. The next one is the e-commerce giant. This is Amazon. Amazon had a pretty solid day today. In my opinion, it probably carried most of the market. We did hit lows of about 2,000 a share. Overall previous highs of 3,700. And this is something that I have to adjust. Again, right now it's at 2,100. So one of the things that I want you guys to take into consideration is that if I see that it has the potential for 3,700 based off of previous highs, let's say that I set my exit to $3,000 a share, right? That my average purchase price, I could even set a more conservative average purchase price, less aggressive. I don't need to go in right away. Knowing that my average purchase price can be 2,300, my exit can be 3,000, and where I cut losses can be 2,000, that still leaves me with a risk to reward ratio of 2.33. The great thing about this is that if I go in, well, I want you guys to understand what the current potential ROI is. So I talked about 70%, look at that, 76% ROI. But based off of our trade plan of $2,200 a share and based off of the resistance at potentially $3,000, and again, in my opinion, $3,000 is relatively pretty low based off of what Amazon offers through all-time highs. That alone is 40%, and realistically, I mean, I see more of a common resistance level, in my opinion, right around 3,400 and 3,500. And the reason that I say that is every time that it would approach that resistance, it would get rejected. Approach that resistance, it would get rejected. Approach that resistance, get rejected, get rejected, get rejected, get rejected. I would say 33 to 3,500 was a more common resistance level. So I'm actually going to change this and set a more realistic of 3,300 as my overall exit and still manage risk at around 2,200. This puts my risk to reward ratio at 3.33, meaning that I have the potential to make 3.33% for every 1% that I'm willing to lose. In my opinion, with what Amazon is, with where I see it to be, not needing it to recover right away, and with managing my position size lightly in the very beginning, it should allow me and give me the time to tolerate the time that it will take for the stock to recover. And then when it does, I can truly begin to step on the gas and benefit from that market recovery. Let's go ahead and break down Apple. So Apple is one of the ones that I find to be the most interesting. I don't know why not more people are talking about it. Apple is probably or was the most valuable company that was ever publicly traded. But I think it was yesterday or 2 days ago that because of how much it has sold off, it's no longer the market leader in the most valuable company that's publicly traded. But even from the price that it's at right now at 142 based off previous highs, it offers 28% ROI. And think about that. Right now we're at 142. I set an average purchase price of 155. There's a discrepancy there of about $13 from where we're at right now, meaning that I don't need to be perfect. I can choose to average up when I want to. Once it's indicating signs of an uptrend, I can average up accordingly. My exit, 175. Looking at previous highs of 182, again, 175, I find it to be a more appropriate and realistic target. Again, setting the expectation low. And then when it comes down to managing risk, if I'm waiting for the break above 150 a share and I'm adding at 150 to 155, then I can manage my risk if it goes below 150. And again, the thing that I want you to understand is that on my original entry, I'm going to be lightly invested. So even if I do end up having to cut losses, I'm going to be in with a fraction of what I normally would be in if we had full-on confirmation. The great thing about this is that by managing my position size in the beginning and by keeping it light, even if things do go south, it makes it not only easier to manage my risk and cut losses, but also my loss is only a fraction of what it would have been if I was fully invested. Again, put yourself in a position to succeed. Make it easier for you not only to lock in profits at best case scenario, but always think about worst case scenario and how you can make it easier for yourself as an investor or as a trader to hold yourself accountable and manage and mitigate that risk. And you can see that the risk to reward ratio on this was 4.0. So for every 4% I have potential to make, I'm willing to risk 1%. And then TQQQ, again, just an example that has one of the highest 6% for every 1% that I'm willing to lose. But that's really just it. I wanted to break down to you guys really the three stocks. I was just going to make a video explaining, hey, these are the three companies that I'm choosing to invest in. That's pretty much it. But I wanted to give you guys more insight on why, right? And I also wanted to share with you guys my trade plan of how it is and why it is that I'm choosing to go in lightly, taking worst case scenario into consideration, and if I have to manage my risk, and then averaging up into my position size only when the market begins to recover and when I begin to believe that the market sentiment is resuming back to being bullish and not so bearish based off of all the uncertainty that we're currently experiencing with interest rates and inflation. And again, I don't expect this to happen anytime soon. I don't need it to happen anytime soon. So my 50,000 to me can be 5,000 to you. It can be 100,000, right? We're all in different positions. The idea that I wanted to empower you to do with this video is to put yourself in a position to succeed, to stay calculated, and hold yourself accountable. Understand that it's going to take time. I want you to plan for worst case scenario. It's great to have goals. It's great to have ROI potential and what amount of money can be made. But none of that matters if you're not holding yourself accountable to the risks that you are taking, because it doesn't matter how safe a trade or how safe an investment is, there always is some form of risk that you are taking into consideration. And if you don't plan for it, then you're simply going to get scared or surprised when it ends up actually playing out worst case scenario, right? So it's better to be prepared than it is to be surprised. I appreciate you guys' time. Again, if you guys want to have access to this little PDF, it is for free. It's the first link down below. You don't have to have it, but if you want to join our free Discord, we have over 40,000 members. In the announcement section, you'll find this little CSV or Excel file there. So I really do appreciate you guys' time. I hope that you guys learned something new. I'm very excited to follow up and see how the market actually begins to recover. Again, it's definitely going to take time. It's definitely going to be challenging, but this is why we start light and we average up into our position to put ourselves in a position to succeed, not just for best case scenario, but of course, worst case scenario. Hope that earned a thumbs up. Please consider subscribing like always. Let's make sure that we end the year on a green note. Pretty sure I just said that, but yeah.